We now move to what I think will be a very interesting part of our agenda, a fireside chat between governors. We have our own governor, Gabriel Makhlouf, back on the stage, along with our moderator for this session, Sharon Donnery, Deputy Governor, Financial Regulation. Thank you.
Thanks, Denise. And Dí Vicarja agus tá fáilte rót go dtí Bóthar Lansdowne. Is Mr. Sharon Donnery, last Governor of Bank Ceannas na HÉireann, agus tá á down orm a bheith anseo inniu. So hello everyone. As Denise said, I'm Sharon Donnery, Deputy Governor at the Central Bank. And let me join Governor Makhlouf and all of our team in welcoming you here today to Lansdowne Road. I'm a dub, Governor Bailey, so it'll be Lansdowne Road to me forever, I'm afraid. And welcome also to all of those who are joining us online as well. We're really grateful for your participation. And thanks for joining us again about your remarks, which I think have really set us up so well for the whole day. So both of you in your remarks touched quite a bit on financial stability aspects and financial regulation, but I think particularly in the current economic climate, it would be remiss of me not to also ask some central bankers about the current inflation outlook. So maybe just starting with you, Andrew, if that's okay. What do you think about the I suppose, overall current outlook for inflation and whether you think we do have a handle on it?
Well, I think there are some pretty common elements across Europe, and I define Europe geographically and not in any other sense, so together, because we've been hit by some pretty common shocks. Obviously, sadly, the Ukrainian war being the biggest one. And so I think we're seeing a fairly common pattern now that the big shocks of last year and a bit before that are now unwinding. So certainly we see in the UK inflation coming down. I mean, it's not come down yet as much as in the euro area, but I expect the next read to be quite a bit lower because we have a particular pattern of energy support measures, which means it adjusts every quarter really, and the next one is the quarterly adjustment, and I expect quite a fall in the next figure because that's, I say, sort of somewhat baked into the annual comparison. However, as we stressed in our report last week, of course our job is to get it back to the target. The target is 2%. I expect it to be quite a bit lower by the end of this year, but it's not going to be down to 2% by the end of this year. And policy has to do the second half, to sort of continue with the rugby analogy for a minute. The second half is not going to be about unwinding shocks, it's going to be about policy. And policy is, we think, now restrictive. We can see that. Yeah, we've got a very subdued growth forecast for the UK. We're not forecasting a recession, but it's very subdued. It's pretty flat. We are seeing policy being restrictive. And the basic, to be clear, the basic message we're giving on policy, and we were very clear again last week when we once again held rates at 5.25%, is that we believe that policy will need to be restrictive for an extended period of time. There are still some upside risks on policy. I mean, the terrible events in the Middle East, I mean, they are terrible in their own right. They haven't actually so far caused a rise in particularly in the oil price, but it is obviously a risk. So there are upside risks there. And I'll just make one final point. It is too early, and I think this is common where you look at the Fed minutes, you look at the ECB, you look at us. It's really too early to be talking about cutting rates. The market, of course, will reach a view. It has to reach a view on the future path of interest rates. Totally understand that. But we are very clear. We're not talking about that. What we're saying is policy is going to have to be restrictive for an extended period to see the second half out, which is where policy is going to have to do the work to bring inflation back to 2%. And I believe it's going to happen. I mean, our forecast suggests we will be back at the target in around a 2-year horizon. I'm optimistic. I think it will happen. But I'm afraid we've got to continue doing the work to make it happen.
And Gabs, do you share that view? And maybe if you want to expand a little bit as well, I suppose I think one of the things that's very difficult for the public to understand is we've gone from this period of low for long and the idea that was going to last for a very long time, and now we're obviously in a very, very different environment. So as well as the current outlook, maybe thinking a bit further ahead, do you think the concept of low for long is something that we may go back to, or you see a different longer term outlook in terms of the dynamics in the global economy?
Let me answer the first part of the question, but I can't add very much to what Andrew said. That's different because I agree very much with him. I mean, there are some differences in the underlying sort of reasons behind what drove inflation between the UK and the euro area. But fundamentally, I think a lot of what Andrew said applies to the euro area. If I was saying, I just want to emphasise a couple of things which Andrew said at the end. Firstly, it is far, far too early, in my view, to start talking about when are we going to start reducing or cutting rates. I also think it's too early to declare, as some have done, that we've sort of reached the top of the ladder, to use the phrase I've been using. Yep. We've got to look carefully at the data, and certainly in the euro area, I think the next few weeks before our meeting in December will be pretty important, and in December we have our next set of projections. We will get inflation down to 2%, but it's the important thing is to be absolutely determined to get there. And as the IMF told us a few weeks ago, don't declare victory too soon, because there's a historical pattern of victory being declared too soon, and that turning out to be misguided. So, I think the answer to your second question about the future, and are we going back to a world of low rates? The honest answer is I don't know. Andrew might know, but I don't know. I think a lot depends on there's too many variables. A lot depends on, for example, what's the role of governments post-pandemic going to be? So, I was having a discussion with some colleagues yesterday whether we're actually moving into a world where governments are going to play a much bigger role in economic life. That has implications for public expenditure, it has implications for debt, that has implications ultimately for what will happen to monetary policy. Whether those gravitational pulls of an aging society means we are going to continue, we will revert back to the sort of low rates that we had, I don't know. Whether technology is going to have the sort of impact that some people think it will have in terms of increasing productivity, etc., as in particular we meet the climate change challenge. So I think it's a big unknown. And certainly I encourage all researchers to carry on exploring this issue, and I expect economists to be debating it for quite some time.
Yes, it is obviously a big debate, and I know something that many, both academic and central banks researchers are looking at, but anything you want to add on the sort of longer-term future, and particularly maybe the structural...
Yeah,
do you have the answer?
I don't have the answer, no. Well, I agree with what Gabriel said. I think there's a tension at the moment in this debate about the neutral rates.
Yeah.
I should say, I can speak for ourselves, we don't use the neutral rate as a sort of policy tool, in a sense. We don't sit down in the MPC, the Monetary Policy Committee, and say, well, where's the neutral rate, so where should we be? It really doesn't lend itself. It's more of an analytical tool. The tension, I think, is this, and I think Gabriel's pointed right. We tend to think about a long-run neutral rate and a sort of more cyclical, shorter-run neutral rate, and I think at the moment they're pointing in different directions. I think you're absolutely right. The long-run sort of structural argument is really, and this is a world economy point, it's not national. It hasn't changed. It's really about aging population. The fact that we all tend to save more as we get older. The interest rate is the price of money, so it's balancing saving and investment. And with an older population, there tends to be a larger sort of amount of saving compared to the demand for investment. And particularly, certainly for the UK, the demand for investment has been weaker in recent times. That's an issue of its own. That, as I think Gabriel Rice said, that tends to suggest we'll go back to something lower. I think the shorter run argument is at the moment it's probably going a bit in the other direction. I'll give you an example. Another of these sort of so-called star variables is obviously is U star, the equilibrium unemployment rate. We actually raised our view on it a bit last week in our report, and really because we see in the UK labour market we've seen a withdrawal of people from the labour market. We've seen, frankly, wage increases which are high relative to what we think is the state of the labour market, because we do see it beginning to loosen, and we observe what's called an increase in the inefficiency of matching people to jobs, all of which led us to increase the equilibrium rate. And I would say probably the cyclical neutral interest rates, there are some upward pressures there. So these two things are a bit in tension at the moment. They'll resolve themselves, but at the moment I'd say we've got things going both ways.
Okay, maybe just one last question on inflation before we move on to some questions maybe about the wider financial system and some of the themes you both picked up on in your remarks. Andrew, you spoke about fragmentation in your remarks, and one of the other aspects of that that's being much debated at the moment, especially in the context of geopolitical tensions, is supply chains and so on. But the supply side of the economy, I think, is also something that's come much more to the fore in the debate about inflation in recent years, and whether we really, in central banks included, sort of looking back now at lessons learned, understand enough about the supply side of the economy and how it affects inflation. So what are your thoughts on that?
No, it's right. And interestingly, it's another point we highlighted last week. So I think at the moment we've got weakening demand in the UK, but we've also got a weak supply side. The best example I can give of this, and actually, Gabriel will have a view on this from his past. So, throughout much of my career, I would say, the potential growth rate in the UK economy has typically been about 2.25%, and governments tend to come in and want to raise it to 2.5% as a sort of policy objective, and they've done it, but it hasn't necessarily lasted. But it's been over 2%. Today, we would put it at a bit over 1%. Somewhere between 1, not 1.5, but somewhere a bit over 1. So that's obviously a big difference. It's also something that complicates the setting of monetary policy. Now, if you sort of step back and say, what's going on here? I mean, I think both the big drivers are weak. So we've got, obviously, going back to this point about aging population, we've also had a withdrawal of people from the labour force. We've got a relatively weak labour supply, growth of the labour force. We've also had very low productivity growth since the financial crisis. I mean, this is not new. This goes back to really the post-financial crisis period. Part of that aspect does reflect the investment story. Part of it reflects higher uncertainty in the economy, which tends to have an effect of depressing investment. And I think there are some very big questions around now. Some people say to me, well, yes, but we're not measuring intangibles very well. Well, even if intangibles investment is higher than we think it is, of course, output isn't higher, so, but just by doing that. So that doesn't immediately solve the productivity problem, actually, at all. I think AI is obviously the big issue then, and we could probably debate that separately, is, well, where's it going to lead to? Is it going to help us with the productivity problem? But I think we have got a supply side issue, there's no question about that.
Okay, maybe one aspect to link that to broader issues about central banks, to understand the supply side of the economy better, for example, we'd have to get more data. And as we all know, as central bankers, we love data, and data is the lifeblood of what we do. But again, looking back a little bit, maybe there are lessons to be learned about economic models and how they rely on historical patterns. But we also know the economy is changing, the financial system is changing, and therefore we also need new data for the future to understand some of these things, including, Andrew mentioned there, the effect on productivity, on AI and so on. So in terms of that wider issue about data and how central banks really understand the economy, the financial system and so on, maybe Gab, starting with you, are there aspects there that the Central Bank of Ireland is looking at in terms of developing our approach?
Well, I mean, I think let me start by saying you're absolutely right that data matters a lot, and at one level you can't ever have enough of it, but there's always a risk that in the modern era we have too much of it. So we need to turn the data into information. I would say, if just go back to your question about supply, I think one of the big lessons from the pandemic and from the recovery from the pandemic is that economists everywhere, and certainly in central banks, need to understand the role of supply. I mean, I think some of us came to conclusions early on which perhaps we shouldn't have done. So that I completely agree with that. Secondly, I think on data, we are investing here at the central bank a lot of effort to be able to actually turn the data that we have into the sort of information that we need, but not doing it on our own. So I think it's really important that the research communities in Ireland, in Europe, globally, actually work together as much as possible to help us understand some of these underlying challenges. And it does, I mean, I think the tools are there, actually, to do that. And mean, that's certainly a focus of us here in the central bank.
It's been a big priority, I think, the Bank of England as well, including with industry engagement, for example, around your approach to data. You want to say a few words about that?
I think we're all in agreement on this. I mean, we're having to go through a lot of work to, in a sense, sort of modernise our approach towards collecting data and using data. I think at the moment, from what I've seen so far, and I mean, like all organisations, I mean, we're interested in AI both as a public policy issue, but like all organisations, we're interested in it for our own organisation.
That's true, yeah.
What are we going to do with it?
Yeah.
That's a big question. I think the caution I would notice from sort of things I've seen so far is that I think machine learning is very, well, its focus is, if you like, on using a vast amount of data to sort of, in a sense, predict one step ahead. And that can be useful, don't get me wrong. It's not, I think, so useful in terms of sort of the more medium-term sort of forecasting we have to do for monetary policy, where you really need a structural model, actually. So I've talked to people who've developed things, say, for instance, things like so-called neural Phillips curves, and it's all very well, but there's no framework behind it. And so you sort of struggle with it to a degree as to what am I supposed to do with this thing? What do I deduce from it in terms of what it's telling me about the structure of the economy? So I think there's a lot to be done there. A lot of potential there, though, I think, as well.
If I can add just one thing, because my natural inclination is to be very cautious about removing the role of judgment when it comes to certainly monetary policy decisions, but economic policy making generally. So I'm sure there are people out there who think they can develop models that will mean that we can get rid of central bankers because the machines will just tell you the answer. I mean, I personally, and okay, my incentives are distorted here, but I personally don't think we're going to reach there. And what we need to continue to invest is to understand how you can use data and information to help inform judgment. In the end, judgment is going to be what matters. Yeah.
I agree with that. My incentives are probably slightly misaligned as well, like your own. And maybe going back then, Andrew, to the comments you made, you talked a lot about the global architecture in terms of the roles of the various institutions and bodies in terms of setting standards and so on. And of course, a big focus of that global work and our own work in both our central banks and at European level over the last decade since the financial crisis has been very much focused on resilience and building resilience in the financial system. And of course, unfortunately, we've had a series of shocks that's really tested that to some extent. But what's your view now, I suppose, at the moment in terms of the overall resilience of the financial system and whether it has, I suppose, both the resources but also the flexibility or agility to be able to respond to potential shocks, particularly in light of the shocks that we now understand that may happen? You know, how many of us imagined a pandemic or the war in Ukraine or even the evolving situation in the Middle East? So that kind of concept of overall resilience in the financial system and where we're at.
Well, it's a huge question, Sharon. I agree with you. Look, I'm going to sort of, let's take the bright side for a moment, the optimistic side for a moment. And I think it's important to do this because you rightly say, we've had some huge shocks. You know, we've had a pandemic, we've had a war in Europe, we've got a war in Europe. We've got the outbreak of hostilities in the Middle East. These are huge shocks. Earlier this year, we did have stress in parts of the banking system. A globally systemically significant bank failed. And we've come through these things. I mean, I think it's important to bear in mind that, and to note that we've come through these things. The system has come through these things. Well, so far, the system has come through these things. And that's important because it tells us something about, something important about the standards we've got today. Now, however, there's always a caveat when you've got central bankers.
Indeed.
And I think there's two. One is you can never sort of say it's done. And that's why we all keep doing stress tests. We keep evolving our stress tests. We keep learning. The second thing, and you and I know this very well from the work in the Financial Stability Board, is that of course the focus has had to shift to the non-bank world. I always say that if you sort of step back for a moment, there's no surprise here because since the post-financial crisis, the share of global financial intermediation has shifted relatively from the bank to the non-bank world. we shouldn't be surprised at this because we had a banking crisis, we regulated the banking system, and we shouldn't be surprised at what that has led to. But it has led to issues in the non-bank world. I think it's led us to understand and appreciate that the non-bank world can be systemically important. I mean, I think if you went back to I remember back earlier parts of my career, I think there were people who quite strongly argued the non-bank world was not systemically important. But that's not true anymore. We've had the experiences. But the final thing I would say is I think the challenge with the non-bank world, I always say, is that it is a very big landscape. And it's a very diverse landscape. And we've got what I call a breadth and depth challenge. The breadth is, it is so big. Frankly, issues have popped up, and LDI is quite a good example, is in some of the less well-known bits of the landscape. Yeah. And the depth issue is also illustrated, I'll finally say, by the LDI issue, because the LDI world of pensions was what I called an 85-15 world. 85% of the funds were basically quite large, single LDI funds linked to single pension funds. 15% of it was pooled funds for smaller funds. We put our focus before the problem blew up on the 85. It was the 15 that caused the problem. Mm-hmm. And there's a lesson in that about where these things can come from.
Yeah, and I know you'll probably want to say something about the non-banks, Governor, because it's one of our own priorities at the Central Bank. But just going back to the issue of resilience first, and Andrew mentioned how we've gotten through, those various challenges. But that's also in the context of very significant support. So if you look back to the pandemic, very significant and accommodating monetary policy support, fiscal support and so on, even kind of regulatory support at that time. So it is, I think, important to emphasise the context. Maybe you want to say something about that. And then I know the non-bank issue is a big issue as well for us here. So maybe you want to say something about that.
Sure. I mean, I want to underline, I agree with completely what Andrew said about the shocks and the fact that no one predicted the pandemic, but we managed it. The financial system coped with it. So certainly the resilience of the system amidst all these other shocks we've also had, its record speaks for itself. And a lot of that is the work that was done post the financial crisis, when clearly the system failed, blew up. If there's one thing in particular, and I'll come back to your other point, but just on the non-banks, the one thing that's absolutely clear and unambiguous to me is that non-banks deserve our full attention. The sector has grown, incredibly. In Ireland, it's grown incredibly. And it would be completely negligent of the international financial community, both regulators and firms, not to recognise that that is an issue, and it is in everybody's interest, firms and regulators, to actually to see something done about it so that the risks are managed. I do worry. I mean, the response to the pandemic was, a very significant fiscal. We saw a very significant fiscal policy response across the world. But and I made this comment a few minutes ago, I do think that governments need to think very carefully about whether they're going to continue that sort of response and what it means for, and certainly in the EU, I think it's an important issue, because it will have implications for monetary policy, never mind the fiscal position of states, etc. So it was a necessary response to a very significant shock, but it was also exceptional. And I just worry a little bit that that exceptionalism isn't being recognised and may build up its own risks in the future.
Okay. Okay. And just Andrew mentioned the work at the FSB on open-ended funds, which I'm very grateful to him for the opportunity for myself and the team here at the Central Bank to work on that. The consultation, if you're following that, closed a number of weeks ago, and we're currently working on the finalisation of those proposals, so you can look forward to those in the coming months. Maybe just before we wrap up, a final topic around innovation. So Andrew, when Gabs was speaking earlier, he mentioned that we're launching a consultation paper ourselves today on our approach to innovation, but it has been an increasing feature of our work, of course, for the last number of years, and we've had a lot of engagement with firms in the innovation ecosystem. But it's also been a big issue in the UK. It's been a factor, I think, in seeing again a growth in innovators or new firms entering the financial services sector. So what's your view on the landscape, I suppose, around innovation and the changes that it's bringing now to the financial system, both in terms of opportunities, of course, which is very important, but also risks?
Well, I think we're in very much the same place. I mean, I think we welcome innovation. We want to encourage it. We want to understand it, of course. But there's no question that it is for the good at root, and we should encourage it. I think it is helping to solve some of the sort of what I call quite basic issues. I think it can do a lot, particularly at the sort of consumer-facing end of financial services, and we should welcome it. So I think all of us are, we're all, in a sense, doing similar things. We're all creating sandboxes and so on so that we can understand and promote it. I think for us, then, the task is to understand sort of what I might call the risks it brings with it and what we do about them. So, I think we've seen that, for instance, in the crypto world, and how we've had to do will have to do a lot of work to, in a sense, manage those risks. I think we see it in something like decentralized finance. It's a slightly slippery concept, but the question I always say for all of us as regulators is that ultimately, as regulators, we have to sort of put our hook into something and say it's you that are responsible. Yep. And I think it's presenting a challenge, but. I think the right attitude for regulators, the right approach to regulators is we have to take it on and come to terms with it rather than try to stop it, because we won't stop it at the end.
Indeed. And Gabs, you mentioned in your own remarks our consultation today. One of the issues in Ireland, of course, both an opportunity and in terms of some of the risks, is, there's a huge tech ecosystem here as well, and we see the financial services sector, I suppose, often working very closely with this intersection between the two different aspects. So it is a big part of our agenda, and as I said, we have this consultation. But anything you want to add on that?
I actually want to just mention one thing that because I agree with what Andrew was saying just now, and everyone knows my views on crypto. I think, one of the things that I mentioned in my remarks is the need to help new firms that are new to financial services, understand what living in a regulated environment means. And certainly we see that here in Ireland quite a lot. But the other thing I just want to say, and again, I mentioned it in my remarks, and I think it's a really important challenge in the world of innovation, which is financial literacy. And I do remain concerned at the amount of investment that is being made in helping people understand the risks, challenges, opportunities, whatever you want to call them, about new innovative products. And we're not, in the Central Bank of Ireland, we're not responsible for financial literacy. But I do think it tends to be a missing, my sort of relatively superficial understanding of what happens throughout the world. I think it's a relatively missing piece of the stability and consumer protection puzzle, that we tend to sort of focus on rules, etc., with firms, but actually helping consumers and investors really understand what's going on probably requires more effort than it's currently being given.
Okay, and very last quick question then. So central banks also have to innovate, and of course you both mentioned trust in your remarks, and money, central banks and public trust, it all goes really hand in hand. But in terms of innovation in central banks, the very nature of money is also something that's being discussed. So maybe just a last word. There's both work at the Eurozone. Gabs, if you want to go first on the digital currency, and likewise, I know it's a big issue for Bank of England. So any reflections on so-called central bank digital currencies?
The whole world is moving in the direction of going digital. So no one should be surprised that central banks are also going to move in the direction of going digital. And I've said for quite some time now that the digital euro is coming, and it's a question of when and how we're going to design it. And obviously we need the European Parliament ultimately to give us the framework to be able to introduce it. But the message, my main message to certainly financial institutions and in particular banks is that they should embrace this particular direction that we're all moving in, and that they should participate in developing the digital euro as opposed to what I'm observing at the moment, which is complaining about it.
Okay, and last word, Andrew.
I agree. I mean, I think the first question is there going to be a role for retail and wholesale digital money? They're slightly different things. Mm-hmm. Yes, I'd be amazed if there isn't. But I start at that point. And what do we mean particularly by retail digital money? It's really about programmable payments, the ability to make the system more efficient. The big point I'm making is it's the same point Gabriel's just made. We're working on central bank digital currency as well. We haven't taken any decisions. It'll be a while before we take the decision. What I would say to the financial system, particularly the banks, is please don't leave us as the only show in town. This is not, I think, the right answer for the money system. We want to work with you on digital money, and out of that, I think we'll decide what is the best sort of, in a sense, next steps to take on innovation.
Okay, well, thank you both very much for your remarks and for participating in our discussion. And we're going to wrap up there, and I'm going to hand back over to my colleague Denise, who's going to introduce our next speaker. So, Gabriel, Makhlouf.